Hey everyone, Patrick Jackson with Mann Mortgage here with this week's market update. Today is Wednesday, one day early, November 2nd. It's about 12:30 on the West Coast. And the reason I'm doing the video a day early is we got the big Fed rate hike announcement today. So I wanted to cover that real quick for you guys, and it's going to be actually a short and sweet video. So basically the Fed rate hike came out. It was 75 bips or 3/4 of a point, which was as expected. Originally when that came out and with the Fed statement, it sounded like the Fed is considering, hey, we can't overdo it. Maybe we back off in the future, based on the way the statement read. And the markets reacted positively. The stock market was up. The U.S. Treasury was down, 10-year, which is good for my rates, and mortgage bonds were up as well. Then Chairman Powell gave his speech about a half an hour after the rate hike announcement, which they do every time. And like we talked about before, his comments have a huge effect on the markets because we get an idea of what they're maybe thinking going forward, not just what they did today, but where they're thinking down the line. And when he made his comments, it came across a lot more hawkish, a lot more aggressive than the original statement read. Basically said we'd rather overdo it on inflation than underdo it. So there doesn't seem to be any backing off of the rate hikes. He did mention a slowdown in the future, so maybe in December, as early as December. So that would be, we did 75 bips. This hike, maybe just 50 next one. I think December 14th is the next meeting. But he didn't. He was very hawkish in his statements and didn't show any signs of backing off. The labor market doesn't show him any weakening signs, so that's not a reason to back off. They don't see any wage price spiral going on, which is another reason maybe to back off. So they stayed aggressive and said, for the foreseeable future, they see more risk in underdoing it than they do in overdoing it. And the markets reacted negatively. Stock market's down big. Mortgage bonds are down. U.S. 10-year Treasury is up, which again is bad for mortgage rates usually. So markets haven't taken that well. It might have been a little bit optimistic for the markets to think that they would back off based on all the other indicators. We know the job numbers keep coming out good, so that might have been a little optimistic on investors' side to just assume that the Fed would do what we would like or what we think is the best thing to do. But for now, it looks like, at least for the foreseeable future, we're not going to see, any major decrease in rates. If anything, tomorrow will probably open up a little bit higher. Today, the average conventional, according to that 30-year survey, is about 7.12, which is down from 7.37 at the high a couple weeks ago, but still much higher than we'd like to see it. And then, going forward, the most important thing to pay attention to will be the inflation data, the next two inflation reports. So here, coming up in the middle of November, when we get October's numbers, if those come in as expected, lower, like we've talked about quite a bit, then that will have a positive effect on mortgage rates, on bonds, on everything, and maybe convinces the Fed at that point to slow down at their next meeting, saying, hey, inflation's getting under control. We need to slow down on our hikes and make them smaller and then taper off. November's number, same thing. Or, once we're in December, we get November's number, same thing. If those next couple months come out as expected, that should be having a positive effect. But if those come out with any surprises, if as predicted, they don't come down and they actually go up, inflation numbers aren't as good as expected, that could have that could definitely delay the process of rates coming down and have a big negative effect on stocks, on mortgage bonds, and like I said, it would increase the U.S. 10-year Treasury. So that's what we got to pay attention to now is basically the labor reports over the next few months, the inflation reports. If we see labor start to weaken, if we see inflation start to come down, then we'll probably see the Fed start to slow down their hikes. If labor continues to go strong and inflation continues to go strong, then Fed will continue. Maybe they'll continue with their 75 bip hikes, which is what we don't want to see. That would continue to raise people's credit card rates and have obviously a negative effect on mortgage rates too. So that's what we got to pay attention to. It is what it is right now, but we'll just have to hang in there. And like we talked about before, there's still options for buyers out there. Things like 2-1 buy downs, permanent discount points to buy down the rates. ARM are still an option for jumbo, at least they're a good option. So if anybody needs anything at all, please do not hesitate to reach out, and I'd be more than happy to help. Have a great day, guys. Bye-bye.